Good evening, guys. I hope you're all well and welcome to today's Technical Tuesday. In this Technical Tuesday, I'm basically going to explain how to capitalize on an area of interest, how to refine your stops, and more importantly, how to use our core content on a smaller time frame basis. And the examples I'm going to use is the two trades we took today, which ideally one of them is floating in a major amount of profit, and the other one we did just get stopped at, but nevertheless it has traded in our specific bias. And if you actually go into the watch list section, the area of interest that I highlighted, it did react off that specific point of interest. But yeah, without further ado, let's get into this video. So Euro USD was a currency pair that I was eyeing up at the beginning of the week, and I want to see higher prices on Euro USD upon this institutional candle here. So let me just put on the hourly markings. I believe it's combined with the 4 hourly. Nope. So yeah, this was the hourly chart I had, and this was ideally where I wanted to see some bullishness, as illustrated both on the market outlook and the trade ideas, and I explained my bias towards that. So if you haven't watched the market outlook yet, go back and watch that, as you'll get a greater understanding on why I was bullish on Euro USD. But just simply giving you a brief top-down analysis, if I just scale into the 4 hour time frame quickly, and combined the 1 hour. So one thing I wanted to show you is we were forming this massive accumulation schematic on a 4 hour time frame. Now again, accumulation schematics happen on all time frames as price is fractal. These range from type 1 and type 2. But when we see an accumulation schematic happen on the 4 hour, daily, weekly or monthly, we understand that a large movement in price is due to occur. You know, it's not just going to be 20-30 pips and we're out of the market. We can then look to swing our positions for, you know, 100, 200, 300. You know, we should be looking at that minimum 250 mark, 250 pips. So yeah, when we sort of see these accumulation schematic on a 4 hour time frame, our next thing we look at is visible liquidity spots, etc. So what I'm trying to say is, once we've got a bias on the bigger time frames, we can then start scaling into the smaller time frames upon price coming to our area of interest and refining accordingly. So as mentioned previously, we did form this accumulation schematic as we saw the PS. There should be PS preliminary supply. Saw that selling climax again. Saw that AR. That again, the manipulation above the AR. Believe we had a STAR. Sorry, over here. And then ultimately sold off to form that STB, then that test. Upon forming that test phase, we did have this slight break in market structure. Again, just counting the bodies, you could sort of see it there. Just clear out this annotations a bit. Yeah, so you can sort of see it there, the break in market structure. So again, a lot of people had that fear of it coming back into a premium. To a certain extent, yes, but the last point of supply normally forms upon a specific candle. So again, this was a institutional candle I was looking, sorry, a sponsor candle I was looking at, or it was this institutional candle here present on a 1 hour time frame. And to me, this 1 hour institutional candle did look a lot favorable, in the sense that we did have this, I believe it was on a 30-minute time frame as well. We did have this sponsor candle within an institutional candle, so it was definitely a favorable bias for myself. Again, just looking at this sort of range here, we had that stop loss hunt with this massive bearish candle. Upon that move up, we did have that small bearish candle that I did mitigate with that candle there. Upon having that break in market structure, again, we had that inefficient pricing there. Again, price rebalance, and we took off ever since. You could argue this was a gap that needs to be rebalanced. Maybe in the near future we may see that happen, but this was a strong area of interest of mine, and yeah, minimal risk was applied on this, but it just goes to show I'm aiming for a 1 to 27. So, you know, even with a 0.5%, you could still gain 15% arguably. But yeah, nevertheless, how we could have capitalized more on this opportunity, for example, you know, getting a more tighter risk reward, in the sense, instead of going for a 1 to 30, we could have gone to a 1 to 40, 1 to 50, 1 to 60, looking on the smaller time frames, in the sense that yes, this was a market execution, but we could we have portrayed a limit order on the smaller time frame in order for this whole process to be sort of a stress-free environment, in the sense that with market executions, you have to be valid at that present moment in order for you to execute that trade at that specific time. While with limit orders, you can wait for price to come to your area of interest, regardless if that be buy or sell, especially on a smaller time frame, because it sort of happens quite quick, and upon the price activating that limit, it ideally goes into profit. But yeah, just scaling into a smaller time frame. So now we've got area of interest, which was this institutional candle, this last down candle that basically had that stop run and formed that spring. Sorry, yeah, spring, that should be. That formed that spring there. Upon forming that spring, we waited for a test. So upon the test phase forming, are we witnessing this break in market structure? We could look at this as a higher low as well. So straight away, that's 3 confluences. Now scaling into the smaller time frames. Just like that area of interest there, which is right here. I'm just going to use the replay mode for this, so you get a more overview, or it's just quicker to sort of come back to that area of interest. So now looking at this from a 1 minute perspective, we'll start on the 5, a bit more clearer. So again, what we can see is these three swing points. So again, a swing point is simply a candle that has ideally a close at this level here, and then the next candle opens just above that close, and then we fail to take out that high there, which basically creates a engineered swing high. And the opposite will be showing for a low. Again, this low sort of be bigger than the prior 2 candles, but we'll have a failure to take out that prior low, which makes it an engineered swing low. The reason I say engineered is because this is what banks ideally this is ideally where retail look to put stop losses. So for example, if this was an engineered swing low, they look at this as a retail pattern called the I believe it's 3-pin bar or something like that. So upon this formation happening, there are a lot of stops present below in this area here. So this can range from 10 to 15 pips, etc. So what the bank's algorithm looks to do is sweep these stops, these engineered swing highs and lows, and upon sweeping those stops, they use that liquidity to then seek higher prices or lower prices, depending if it's buy side liquidity we're needing to take out, or sell side liquidity. But yeah, that's just a bit about engineered swing high and lows. And what I mean when I say an engineered swing high and low, those are sort of wondering. So again, we have an engineered swing high here, engineered swing high here, and another engineered swing high here. They've all been swept with that impulsive candle, but just look at what happened before we saw that massive bullish impulsive move. Just getting into the 1 minute time frame now, or I believe a 3 minute will do. So again, we have this accumulation schematic type 2. So we've got the preliminary supply, we've got that selling climax, AR, ST. We have that rally above the AR, taking those stops, and these relative equal high / triple tops. Upon taking those stops, we then take out the sell side liquidity that was present below the SC, and ideally form these relative equal lows here. Upon forming those relative equal lows, again, we had a sweep stop loss hunt, arguably, and upon that stop loss hunt, we see that break in market structure, which ideally liquidated these equal lows, equal highs here. Upon liquidating those equal highs, we had that pullback to where this 1 minute sponsor candle. So again, this can be considered as a risk entry, and if you're a bit more of a conservative trader, there's 2 ways of looking at this from a conservative point of view. Firstly, having a bit more of a bigger stop loss of 4.4, arguably even a 5 pip stop, right, and that would sort of clear you quite nice. Or if you're more of an aggressive trader, you could have your stops literally at the bottom of that sponsor candle there, which would basically make it a 2.5, 2.6 pip stop. and then basically swinging for our initial target. Make this color a bit more darker. So yeah, the overall target still remains the same, but the partials, etc., they still come into consideration, in the sense that we take partials whenever we've broken market structure effectively, come to inefficient pricing, come into a valid sponsor candle. And when I say valid, it's on that specific time frame. You know, it's coming towards a certain area of interest. So yeah, if you haven't watched that partial video on when to take partials, when to move stops to break even, etc., basically trade management is on the last technical Tuesday, so do watch that. But nevertheless, this order would have activated nicely. If you did have an aggressive stop, you may, you know, just would have survived this, but I always recommend just putting an extra pip or two on your stop loss, just to account for spreads, etc. But yeah, nevertheless, we did fly ever since then. Now, let's say you missed out on this entry for whatever reason. The take profit wouldn't be here. The take profit would be on that initial sort of target on the hourly time frame. But again, I'm using the 1 minute time frame. Sorry, 3 minutes. So it'd be a bit hard to mark out that hourly mark. But yeah, just getting into a sort of smaller time frame now on a 1 minute time frame. So we understand that now sort of banks are net long on Euro USD. We can see just from this impulsive price action, we've liquidated these prior engineered swing highs here, and upon a liquidation, there's always a retracement / pullback. We just got to understand where the significant pullback is. So firstly, we look at sort of a fib retracement, in the sense that are we in a premium or discount within this whole range here. So we've come into a discount as the premium is above the 50% level and the discount is below the 50% level. So again, that's a strong confluence on our list straight away. Secondly, we want to look for liquidity. So again, I can see relative equal lows present here. I can see relative equal lows present here. If I just remove this for a second, so we can just focus on this candle a bit more. But I see relative equal lows present over here. In saying that, this was the last down candle before the up move that hadn't had no prior mitigation to it. Yes, this was another candle as well, but I just prefer this sort of bodied. I like using sponsor candles that have a big body to it. It basically indicates that, you know, a decent / large amount of orders were placed in that specific candle. So yeah, I do favor these candles over the doji type candles, but that's something I'm backtesting, and a sort of strategy I'm creating on upon refining these sort of candles on a bigger time frame, as these candles on a bigger time frame actually illustrate the larger bodies on a smaller time frame, if that makes sense. So yeah, these sort of big wicked candles with a small body inside that candle on a smaller time frame is actually a very valid sponsor candle on a smaller time frame. So yeah, but anyways, we're on a 1 minute time frame. You can't, again, you can go to the seconds, but to a certain extent there isn't any point. But I will show you an example where you could have gone to the seconds in this sort of trade. But yeah, nevertheless, getting back onto the example, we had that 1 minute sponsor candle there. Upon reaching the sponsor candle, again, you could have highlighted it from the wick like that and use that whole area of interest, but I like to use the body and more specifically sometimes the mean threshold. But when you go to these sort of smaller time frames, you've got to understand price just likes to mitigate / wick to a specific level and then shoot off straight away. And for example, if you're using a limit order here, I think it takes 0.5 to a pip spread in order to activate the trade. So you don't really want to be taking the trade off the mean threshold, rather you know, the open of the candle, or yeah, possibly even the high. But nevertheless, we did come to that candle to the T, and again the stops will be just below that candle there, and you could have accounted an extra pip. So if you had a sort of aggressive stop here, that would have been a 2.3 pip stop, and again you could have accounted for a extra pip there. So maximum you're looking at is 3.2 pip stop, and all in all this would be your ultimate justification entry, in the sense that you've got one confluence over here mitigated with a sponsor candle. You see that major break in market structure that's liquidated 3 prior engineered highs. Upon that, you've seen that retracement, swept relative equal lows and mitigated with that candle there. And then yeah, ever since then we have seen higher prices. And if you're sort of monitoring this trade now and you see this bullish reaction here, I'd be break even as soon as we sort of come to this level here or break that sort of structural high. You can also trail your stops, and what I mean by that is, let's say prices sort of reach this level here and it wants to pull back maybe even to this candle here, which it didn't, but let's just say this was a candle here. In order to reduce your risk, you can maybe now put stops to sort of 1.1. So if there was a possibility that maybe this was an engineered swing low and there was liquidity present below this low here, and possibly wanted to even come to this candle here, your entry is still protected in the sense that if price, let's change this quickly, if price wants to mitigate with your entry or sponsor candle once more and it comes to this region here and it sort of taps around this region here, you're still safe. That sponsor candle is the last area of interest that price can go to. You know, if it goes below that low there, then you know that's it, the trade is violated. And in that sense, you're basically reducing the risk from a whole 1% risk to maybe even 0.5, 0.4, 0.3, depending on how you trail your stops accordingly. But yeah, that's just something to think about. Like, this will be the next area of, this will be the next break in market structure I'll look at. We didn't actually get that break in market structure to a certain extent. We more so had that retracement, maybe to have a stop loss hunt on that prior low there. But yeah, what we did form was these relative equal highs here. I believe it was present on a 5-minute time frame. So yeah, we have these relative equal highs here, triple top. Again, a small sell-off to attract retail to sell. Form these relative equal lows here, and again attracting retail to buy, a stop loss hunt, and then we see higher prices ever since. So yeah, that's how to sort of look at price action in a bit more in depth on the lower time frames, and yeah, just incorporating Wyckoff on the lower time frames, because 9 times out of 10, as soon as when we reach a valid area of interest, a Wyckoff schematic will happen. So it's not just, oh, the limit's going to hit and it takes off straight away. It's price is going to accumulate orders in that specific area. Like if the algorithm is putting such a large amount of orders on Euro USD, they're going to need a large amount of contracts. In order for them to visibly have those contracts present in the market, there needs to be some sort of accumulation present on that specific currency pair. So yeah, that was Euro USD. Let's get into our next example now, which was Euro NZD. Again, a trade we were long in. Just to quickly show you the overview of the bigger time frame. So again, it was 1 hour and 4 hour combined. I did get stopped at break even on this, so I believe we were about 30 pips up from entry. So yeah, around about we did reach that 30 pip mark. But yeah, it was an unfortunate trade in the sense that it's just had, let's see how many pips from here to here. So we just had that 100 pip mark and took out that relative equal, these relative, well, we formed relative equal highs, but we took out this engineered swing high, and yeah, had that small retracement now, and it looks like we are going to go higher on Euro NZD because of these relative equal highs here. But nevertheless, yeah, I will monitor for possible trade re-entries. Maybe during Asia we could have a sort of sweep of this double bottom / relative equal lows, come into this inefficient pricing, and because price is so bullish, maybe even just hit the 50% mark here and then take off, and that basically is in line with this institutional candle here. So yeah, we could possibly look for something like that to form tomorrow, but that's another conversation in itself. Just scaling into this sort of area here and how we could have refined this area to see the overall picture on a smaller time frame. So now we've got our area of interest on a bigger time frame. We can then scale it into a smaller time frame, for example the 1 minute, and again just using the replay button so I can see, or it's just more easier to get to. So again, 1 minute time frame, we do have these relative equal lows here, but I believe this was the price point that we reacted off, or did we actually catch it from the bottom? But nevertheless, there was a specific price point we reacted off and we went straight into profit. And again, those are the sort of trades that we favor, in the sense that when we take a trade, we'd only be in consolidation or drawdown for a long period of time, as that messes with psychology, that messes with your emotions, and ideally that messes with your capital, in the sense that, you know, you could possibly take the trade early even though it was a winning trade because it was in drawdown for so long. So yeah, that's why time and price is also important, in the sense that if you're trading pound dollar in the Asian session, like, it's obviously going to consolidate, whilst if you take it during London or New York, one of the pairs that it's most active in, then that's when we see them sort of explosive setups. And upon seeing that 50-60 pip move within a intraday perspective, that's where we can start looking for overall targets, partials to take, etc. But yeah, just getting back into the example here on the 1 minute time frame. Again, looking at it overall now, we did have them sort of relative equal lows here, and we did form this Wyckoff schematic type 1 here. So again, we have that preliminary supply here, SC, AR, ST, had that rate above the AR. Upon that, we had that STB, we had that spring. Upon forming that spring, we did have this 1 minute sponsor candle with the entry 1 here. So again, there's a multiple entries present, but if we actually look at this in a bit more in depth, we actually see a consolidation range. And what we know is after every contraction / consolidation range, there is an expansion move. So we had that contraction range here, but if I just sort of scale into a Wyckoff schematic in a bit more in depth on the ins and outs and what to actually look for, upon every spring there is a sponsor candle, and upon every move down to the spring there is an institutional candle form. So what I mean by that is, in order for us to raid this prior low here, or these relative equal lows here, or arguably raid STB and form that spring, there needs to be the last up candle before that very bearish impulsive move. And this was a very bearish impulsive move on the lower time frames, especially on the 1 minute, is because just look at these sort of bearish candles here. 1, 2, 3, 4, 5, 6 Marubozu candles continuously with minimal pullback. So upon that raid, this candle needs to ideally be mitigated with. And again, we had that contraction range, we had that last down candle before that up move that ideally broke these last two structural highs. Again, I'll class them minor breaks in market structure, but nevertheless we did get a mitigation of that candle there, and possible trade could have been taken like this. So again, that's a 1.7 pip stop. If you wanted to account for spreads as well, 2.7 there, and ideally look for our target to be hit. But the institutional candle, the last up candle before that down move that ideally formed that stop loss hunt and that sponsor candle, we then saw that bullish reaction straight through it, and we've literally mitigated it to the T. And just look at how these bodies respect that candle there. We didn't actually have a solid candle closure below this candle here. So again, wick, again a full body closure but just below that level there, and again a wick, that just that end of that candle but wicked just below that institutional candle there. And from there, that could have been another entry opportunity. If you didn't take sort of part in that one, there could have been another one. So just scaling and letting price do its thing, again, not just jumping in at any random time. We'll see that next bullish move, not impulsive as we do form a couple dojis, etc. Had that small pullback to a sponsor candle, then saw that bullish reaction, arguably broke market structure quite aggressively with these continuous bullish candles here. Then what do we wait for? A pullback. We wait for a pullback and act accordingly. Again, we see this sort of price range that price reacted to previously. So we sort of highlight that as an area of interest. We have that stop loss hunt within our area of interest that took out this prior low here. Upon that liquidity gained from the bank's algorithm perspective, we did have that push up to form them relative equal highs there, and what do we have? That pullback, and this was basically our justification entry that mitigates with the sponsor candle here, and then ever since then we have flown into profit. But yeah, that's basically what I look for on a smaller time frame and how I put everything together. And again, it's one of them where you have to train your eye. You can't just sort of jump into the smaller time frames without a directional bias on the bigger time frames, and sort of try and snipe the market in a way. I do always elaborate / put trade ideas or my charts based on the higher time frames, strictly because if I understand where the higher time frames are going to go, the smaller time frames are literally a playground, in the sense that I can swing for, you know, a 100 pip move with a 2 to 3 pip stop, because I understand the next directional bias on the daily, on the 4 hour, and arguably the 1 hour. If you use the 1 hour as your daily and you use the 5 minute as a place to take entries, look for setups to form, etc., you'll see a plethora of setups, and yeah, it just sort of gets better and better like that. But the main way of training your eye is literally through backtesting, and one way I would recommend backtesting is scaling into both London and New York and finding currency pairs that react accordingly to those two sessions, and upon sort of New York open to New York close, London open to London close, find them setups, understand you know, stop loss hunts, upon a stop loss hunt, mitigation, upon a mitigation, where does price react to next. So you're constantly just refining not only the methodology, but you're refining your viewpoint in the markets, and training your eye to see them opportunities happen on a frequent basis. And then upon getting comfortable with that, you can then start sort of analyzing the bigger time frames, in the sense that, okay, where is the 4 hour going upon reaching my area of interest? Is it in that Pacific London session? And then what you'll basically have is your own model. So for example, you will personally favor firstly a stop loss hunt. Upon a stop loss hunt, you want to see a break in market structure, then mitigate with a sponsor candle, and that basically has to happen in New York, and that is the model you follow. That is the only sort of thing you look for in the markets, and you know, just by following that, it will give you that desired, even on the smaller time frames, 30-40 pips, or if you're looking on the bigger time frames and scaling into a smaller time frame, arguably that 300-400 pips. But just having that model in mind, you can analyze it both from a daily structure, 4 hour structure, you know, 1 hour structure, all the way down to the 1 minute structure. You understand that's your specific model, that's your specific niche. But yeah, that's just a bit about refining, and yeah, trying to get the best entry possible. I hope that was a insightful and useful video. Again, if you do have any questions in general or this video specifically, please drop me a message, and yeah, let's continue to smash the rest of the week. Once again, thank you for watching this video, and I hope you all have a good day.